Hello and welcome to our webcast. I'm Cole Mertz with Moss Adams, and I'm getting us started for today's session, Professional Services, Tax Planning Strategies, and Considerations Business. Before we begin, I am going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
The presenters' bios and contact information are located in your webcast console for your convenience. And now I'd like to turn the floor over to Laura to get the presentation started. Laura.
Hi, Cole. Thanks very much for joining us, everyone. My name's Laura Theiss. I'm a tax partner in Denver. I've practiced public accounting since 2004. I'm a CPA, and I have my Master's of Taxation. I partner with clients to provide compliance and tax planning services, specifically in the industries of real estate, professional services, and other service companies. I work with clients closely to make sure that the business owners have financial enhancement and results as it relates to tax planning and structuring for their businesses. Dustin, do you want to go next?
Yeah, good morning or good afternoon, depending on where you're at. I'm Dustin Hubbard. I'm a managing director out of Denver as well, working in the state and local tax practice, consulting with clients around expansion into new states, handling state tax laws as they move from one state to another or expand into new states. And we'll talk about some of the fun nuances that we've seen over the last few years in my section of the presentation. Jarrid?
Yeah, Jarrid McAuliff. I'm a director in our credit and incentives practice group. I specifically focus on real estate and professional service companies, providing cost segregation, energy efficient tax credit and incentives planning, and so forth related to their business investments. I've been doing this since 2012.
Hello, my name is Josh Jirava. I'm a senior manager in the R&D tax credit and incentives group here at Moss Adams. I work primarily in the Seattle area, but I do quite a bit of traveling to serve clients across the U.S., and I've been with Moss Adams for a little over a decade now.
Well, tax planning, specifically year-end tax planning, always starts with evaluation of what's going on during the year and some critical questions that help inform and really identify opportunities for tax planning. So the first step is to evaluate, review changes in strategy as shifts that have occurred during the year. How has your business evolved during 2024? Has your business model or customer base changed or shifted jurisdictions? How has the business expansion been financed if you've had expansion? Analyzing changes in debt to equity ratios can also be of critical importance. For every business, maintaining proper working capital ratios and cash flow levels has never been more critical. It's a key focus. And so with tax planning, we want to make sure that the tail doesn't wag the dog, so to speak. And all of the tax planning that we do is in a sound economic, from a financial decision-making capacity. So when we ask questions like, does the business plan call for additional investment in fixed assets? We want to make sure that there's a business need there. Is there a need to potentially utilize equity compensation and strategies as part of your tax planning? That can be a key part of any succession strategy. The second part of tax planning is really understanding complexities that can help or hurt your business. And some of these we're going to talk about more in depth later in the presentation. The first item is research and development credits. Starting in 2022, the Tax Cuts and Jobs Act required companies to amortize their R&D costs over 5 years instead of deducting them immediately each year. So we'll go more in depth into this later in the presentation. Another potential opportunity are business energy tax credits and deductions, specifically 179D. Again, we'll talk more about this later in the presentation. There's also work opportunity tax credits that can be really beneficial. This involves hiring new qualified employees and is a federal tax credit available to employers for hiring and employing individuals from certain targeted groups. The 163 limitations and changes was part of the original Tax Cuts and Jobs Act that was passed in 2017. So there is the potential that there might be a restoration of depreciation and amortization provisions that were previously available, because generally speaking, adjusted earnings, our cap on our limited interest expense is subject to 30%, and being able to add back depreciation and amortization could be a possible tax advantage. And so we'll talk about that more in depth later. Also, cost segregation studies. The impact of the changing bonus depreciation rates might also inform our tax planning. We'll also talk about this later in the presentation. So some general business tax planning concepts to consider for many of our professional service companies involve, really analyzing whether a change in accounting method might be beneficial. Some of these non-automatic changes must be made before year end. The IRS anticipates changes for IRC 174 R&D expenses will be an automatic change in 2024. We need to stop and consider whether accelerating or deferring income or expenses in light of current and future effective tax rates might be beneficial. With the Tax Cuts and Jobs Act, there are many tax rate changes coming potentially if Congress doesn't act. Triggering unrealized gains and losses might be another consideration. We want to make sure that we're using tax attributes against current income and gains instead of possibly using them against future lower rates. Anticipate and plan for 163J limitations If the business expansion was coupled with lower levels of taxable income, and that business expansion has been fueled with debt, we don't want the interest to be trapped, and we want it to be able to reduce taxable income. And so there's planning that can be done to make that happen. For service-based companies, compensation and retirement strategies can always be a really important part of tax planning. Under the Secure 2.0 Act, we have a longer amount of time to consider and model the impact of retirement plan changes, because the date was extended to modify those retirement plans. And so you can actually do it after the end of the tax year and also make retirement contributions after the end of the tax year. Change in compensation plans, such as non-qualified deferred comp plans and or the timing of bonus payments, can also be an important part of tax planning. Alternative forms of equity compensation to reward and support succession planning strategies can be another powerful incentive. These forms of equity compensation plans can vary depending upon your entity classification. There's also potential changes to employee benefit plans that can be considered, especially with some of the changes with the Tax Cuts and Jobs Act, which we'll get into in a few slides down. So here is a visual of some of the sunsetting provisions as part of the Tax Cuts and Jobs Act. So the Republicans may attempt to pass concurrent budget resolutions and adopt the budget reconciliation process in the first 100 days of the Trump administration. The tax legislation is going to be drafted by the House Ways and Means Committee and the Senate Finance Committee. The Joint Committee on Taxation is going to assist on technical tax issues and scoring of the legislation. The scoring of the legislation under the Byrd Act is going to be really important because that's how Congress is going to measure how much in terms of a tax bill can be passed. There's discussions of changing the way that is measured. And so that's something to keep your eye on. Generally speaking, extending everything as part of the Tax Cuts and Jobs Act is supposed to cost somewhere between $4 to $5 trillion under current law. So it's a big price tag that we're talking about. And there's lots of, we'll call it competing priorities with what has been promised on the campaign trail by Trump, and also, what is practically must be passed, right? So we have some sunsetting individual rate cuts. That is one of the more expensive provisions. However, the corporate rate is not scheduled to go back to what it was prior to the Tax Cuts and Jobs Act. So likely you're going to see some movement there from Congress. Additionally, individuals had a higher AMT exemption amount, so less individuals have been subject to AMT since the Tax Cuts and Jobs Act. Correspondingly, corporations had AMT exemptions that likely will not sunset after the Tax Cuts and Jobs Act ends in 2025. The 20% pass-through deduction is another key provision that is the difference between individuals and corporations that helped lower that gulf. And so that's the 199A tax deduction. The state tax deduction was also, the exemption level was doubled. Dustin's going to talk more about the $10,000 cap on state and local taxes and how that plays in to the pass-through entity tax elections. We also have excess loss limitation provisions that are not subject to expire. These last three we've talked about in some detail and we'll talk about again. There are certain expiring fringe benefits that will change, specifically for cafeteria plans for on-site employee meals. There will be no deduction in 2026. Moving expenses, generally right now, they're taxable income to the recipient. In 2026, they'll be excluded. Bicycle commuting reimbursements, generally right now taxable. In 2026, you'll be able to exclude up to $20 per month for employees. So that could be something you might want to add back if you previously changed fringe benefit plans. Some business provisions that are not currently subject to change, again, the 21% corporate tax rate, net operating loss limitations. These are generally limited to 80% of taxable income. We've talked at length about the 163J provisions. Like-kind exchanges, there will be no change. It's still going to be limited to real property. And then R&D expenditures, and we're still able to utilize better accounting methods for certain small businesses. 179 expensing, this is not going to change. The exemption will remain at 1 million with phase out starting at 2.5 million. The elimination of the corporate AMT, again, this is not going to change, but the Inflation Reduction Act did add back a AMT for certain large corporations. Entertainment expenses, still no deduction allowed. Transportation and fringe benefits, still, again, not generally permitted. There's a big question, and likely, I think Congress will, again, extend 199A and the 20% qualified business income deduction. But if they don't, some considerations that might come into play. Do you think the 20% corporate rate will remain? Are you going to consider evaluating your choice of entity possibly with 199A set to expire? Are there opportunities to accelerate income into lower rate years? And have you identified and evaluated your accounting methods to potentially identify opportunities to accelerate income into lower tax rate years? We'll talk more about bonus depreciation, but generally speaking, it's been reduced by 20% per year on an ongoing basis, making depreciation provisions less when you place new property into service. There is still opportunity, though, to revisit your repair deductions potentially. Lastly, we had the Corporate Transparency Act and beneficial ownership reporting, which is scheduled currently to go into effect. Interestingly enough, just last night, there was a new development where potentially this was blocked nationwide by a federal court just yesterday. And so we might see new developments on that reporting, which is required at year end. Cole, do you want to take us through our first polling question?
Sure, thanks, Laura. For our first polling question, we have, what key expiring provisions of the Tax Cuts and Jobs Act are the most likely to be extended? A, Section 199A, deduction for qualified business income, 20% pass-through deduction. B, elevated estate tax exemption. C, bonus depreciation, restoration of elevated percentages. D, individual tax rate cuts, or E, all of the above. I'll give you about 10 seconds to respond here. And while you're responding, to respond, please click the radio button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide viewing area. First polling questions now closed out. Back to you, Laura.
Oh, it's over to me. So Dustin Hubbard here, going to talk about state and local taxes and things that we've seen over the last couple of years. And we've talked about these over the last couple of years ad nauseum, but I thought they were important for these to be brought back up because of a couple of different issues on this first one. With the expiration of the SALT cap at the end of 25, the pass-through entity elections in the various states come into question, and what should we be doing with those? So I'll give you a little background on that. And then the other things that I'm talking about throughout the rest of my presentation are just things that we continually see come up as issues / opportunities for clients in the professional services space. And so I wanted to make sure that we talked about those. But from a pass-through entity tax perspective and the elections that are out there, just wanted to highlight there's 36 states out there that you can make that election in. That leaves only 5 states that impose an individual income tax that haven't passed some sort of an election for you to be able to make. And I think that's telling in the opportunity that sits there if you haven't been making those elections to take a look at it and analyze it. The rules are very, very different across the states. The years in which they became effective, most of the states hit 21 or 22. You saw probably 25 to 30 of the states come online then. And then the other 6 or 10 states have trickled in over the last and added 23 and even 24 have become effective elections at that point in time. Who's eligible to be included and whether or not you can have an ineligible member and still be able to make the election. So if you're a pass-through entity that is owned by another pass-through entity, in some states you can still make that election, but the income flowing to your pass-through entity owner is excluded from the calculation of tax at the entity level. In other states, in that same scenario, you're not even allowed to make the election. And so that's a different rule across the states that needs to be looked at. And then the interesting one is owners being able to opt out. In a handful of states, you can have the entity make the election and have specific members opt out of the election, meaning that when you calculate the taxable income and the tax liability at the entity level, the income flowing to those members who opted out isn't included in that calculation. And I state that it's interesting because in a partnership context, it's fine, you can fix it. But in an S Corp context, you're going to end up with some inequities amongst the members. And if you try to solve those inequities through the S Corp, you have a potential S election violation where you no longer are allowed to have an S election because you end up with 2 classes of stock, essentially, is the way the rules would work. And so it's something that you got to be very careful and tread lightly around, because trying to cure that thing can cause a whole lot of issues that you really didn't want to be dealing with. The other differing rules is whether the credit is refundable that flows up to the owners. Can the owners use that and any excess credit is refunded? Is it carried forward? Is it limited in some way? So some states out there only allow you to take a 90% credit on the taxes paid at the entity level, or is it just simply lost? And that is highlighted in the second part of this slide with Hawaii. Hawaii used to be, they changed all this, but they used to be where they had the rate at 11%, which was the highest individual income tax rate in the state. And any excess credit was simply lost. It didn't carry forward. And it made it very, very difficult to find clients or taxpayers paying tax in Hawaii where making the election was a viable option just because of the constraints and the tax rate that they put on the entity. They did change that for 2024, so now it's a 9% rate, and you can carry that credit over. And so that's a big change and puts Hawaii really, truly on the map as a state that you could make the election in. Connecticut was an interesting state in 2018 after the federal law was passed in 2017. They just went to a mandatory entity level tax, and they thought that was the easiest way to get around it for their constituents within the state or the taxpayers within the state. And so they just made it mandatory that the entity had to pay the tax and the credit would flow out to the members. it's no longer mandatory for 2024. They've changed those rules. But what they did go back to is pre-2018, they had a mandatory composite return, and it goes back to having a mandatory composite return required for non-resident members. You can take the PTET credit on that composite return, so you end up in a very fair scenario in my mind. But it does make a big change. And then Missouri had a big change. They fell on one of those handful of states where individual owners are able to opt out of the election and move forward that way if they so choose. So what's the future here? There's a couple of different things, and this slide's broken out into them from a federal perspective that are going to really potentially affect the PTET elections. And the first thing is, what's Congress at the federal level going to do with the SALT cap? There's some options on here that I think have all been put on the table and played around by different members of Congress. Full repeal, you'll find that in the high tax states. You've got both Democrats and Republicans pushing for a full repeal because it just really does hamper their constituents. And so that's what they're looking for. At a minimum, a lot of them are looking for at least an adjustment in the cap, pushing that $10,000 number up to something much higher. I've seen numbers in the $60,000 to $100,000 range. Which is a pretty significant jump. Not sure it will go that high, but I do think that there has to be something done just simply because of the slim majorities that the Republicans do have in Congress in order to get the Republicans from those high tax states on board with any sort of legislation. They're going to have to do something with this law. Extend it out more years. Keep in mind it expires at the end of 2025. So if they do extend it or they do adjust the cap, they're going to extend it out for more years. There is some discussion about making it permanent. Not sure that they'll go that far, but or if they even have the option to make it permanent. But that is happening out there. The other thing that comes into play is the federal legislature's ability to limit the PTET elections, because keep in mind this was something put in place to pay for a lot of the Tax Jobs and Tax Cut and Jobs Act. They haven't seen it pay for it, right? Because PTET elections essentially got rid of all the revenue that the IRS was going to get or the federal government was going to get. From this, the PTET elections have diminished that benefit or that payment method. And so there is some thought, even if they do adjust what they're going to do at the cap, if it's kept in place and the amount's adjusted or it's extended, they're going to have to address PTET elections and whether or not those things are valid. And so there is some discussion out there. Keep in mind, the only reason why these things are allowed is because of an IRS notice that was issued at the end of 2020 allowing them, and there was regulation supposedly coming, but we all know that from an IRS perspective, regulations can either be issued or not, and we've been waiting on some regulations for 60 years and we still haven't seen them. So will the legislature at the federal level act on the PTET elections and limit the scope? And what I mean by that is, will they look at the size of the partnership or the size of the S Corp or what industry they're in and say only these industries or only this size of a partnership or S Corp can make PTET elections and deduct the state taxes on the entity level return, limit the benefit. So maybe they could go in there and say, yeah, you can make these elections, but we're only going to let you deduct 70% or 60% of the taxes that are paid at the entity level and come up with some percentage that's allowed to flow through, or just block the option. There has been discussions about whether or not state taxes should be deductible at the entity level and whether or not they should just get rid of that state tax deduction for entities. And so those are all things that are on the table. Where will it end up? I mean, your crystal balls are probably as good as mine, and mine's pretty foggy with regards to this, but I think it's worth the discussion and it's worth talking through. So as a taxpayer, what are some things that you've kind of got to think about? This slide goes into depth a little bit on how the states adopted their PTET elections. And there are 10 states out there who in their legislation in one way or another put in some tie to the federal expiration of the SALT cap. 5 of those states, their law simply states, as long as there's a SALT cap in place at the federal level, you can make a PTAT election. Colorado, Iowa, Massachusetts, Michigan. Those are the 5 states that did that, okay? 5 states that are listed on that third bullet there, California, Illinois, Oregon, Utah, and Virginia, actually put in their law that their PTAT elections expire 12/31/2025, tying it to the federal expiration of the SALT cap, but using a specific date rather than general language about the cap being in place. So if the cap is extended in some way at the federal level, these 5 states, in order to keep their PTAT elections alive, are going to have to do something actively to continue their PTAT elections. So that's something to watch if you're in one of those states or you've been making the election in one of those 5 states. It is important that you watch and see at the federal level, what do they do at the state? Then once it gets passed through the federal level, what are these 5 states doing, and are they going to keep their PTAT elections alive post-2025? Other things to be thinking about, that first bullet there, state law tied to the federal statutes. That's the previous slide that we just talked through. The other things that I think companies that have been making these elections need to be thinking about is credit carryover utilization, and what is the impact of that carryover going to be based on what happens, again, both at the federal level and at the state level, depending on where you're at. And so it is important. Some of those credits, you could have a decent carryover. Most of them have a 5-year expiration. And so planning out, am I going to be able to utilize that credit carryover before it expires so that I truly get the full benefit of the PTAT election in prior years versus losing some of that credit. Multi-year elections that carry past 2025. So an example of this is the state of Michigan. You make the election, it's an election for 3 years. If you make that election in 2025, what's going to happen if that expires? Because remember, it was on the previous slide. And so it's important to look at those states where you have multi-year elections in place and see what the state does about the fact that you are still bound by that election that you made in 2025 for the next 3 years. The other thing is structuring. And what we did see in 21, 22, and 23 is companies and entities putting in pass-through entities or converting to pass-through entities of some kind in order to take advantage of the PTAT elections. Do we need to unwind those structures? Maybe, maybe not. As we unwind those, as Laura was alluding to on the tax rates, does it make sense to unwind and allow and unwind to a C Corp? Or does it make sense moving forward to move to a C Corp? Things to consider and think about. In the states that will continue having an election moving forward, even if, let's say, in a perfect world, right? Because trust me, these things have been a headache. They've been good for people, but they've been a headache to deal with. So in a perfect world, they repeal the cap at the federal level, but states continue to have elections in place. Does it make sense to continue making the PTAT election? There are some non-tax benefits, such as non-resident filing requirements. If I make a PTAT election, does that alleviate my non-resident filing requirement? Do I still have to do withholding? Do I have to file a composite return? And if I can get the benefit of those things taken, or the administrative cost and burden of those things taken away by continuing to make the PTAT election, does it make sense to continue to make the PTAT election? And then the last bullet on here, business valuation issues or concerns, I guess, is if you've been valuing your business with a PTAT election in place and the tax rates in place, is your value still going to be the same as you remove those elections moving forward? Or if you adjust as things are adjusted at the federal and state levels, is my business valuation going to change because the tax expense being reported on my financial statements is now different? So some things to think through, some things to consider as you're going through that. Nexus is on here, and apologies, I didn't adjust some of these bullets as I was copying and pasting from for formatting purposes, but we'll talk through it. Nexus continues to be something that we see as we work through M&A deals, as we work through bringing on and onboarding new clients. Nexus is top of mind and a big concern for them, both from an income tax and from other tax perspectives. And so things to think about here are your remote employees and what are they doing? Because a lot of the pandemic relief, states have put in and said, hey, having a remote employee here during a pandemic is not going to cause you to have Nexus. Well, most of those rules have gone away. And so by having a remote employee in a state, your company may now have a filing requirement in that state. That's what Nexus would indicate, is that if you have Nexus, you have a filing requirement and some potential tax liabilities in those states. So are we tracking where people are working and where they're living to make sure that we know exactly what our filing footprint looks like and what our potential exposure or tax liabilities across the country look like? Same thing with traveling employees. So if we have employees that are sales reps traveling around, if we have consultants who are moving and sitting out on site at a client's site, are we tracking where they're going, how long they're being there? Because that physical presence of that employee or even a contractor to a certain degree will create Nexus and some filing requirements for the company. And so we need to be able to track those and understand where those are at. The biggest question I get with traveling employees is payroll type questions on when do I need to start withholding on that employee? And that is a whole can that is fun to open up from my perspective, because it's very intriguing, and it comes down to an analysis of concern for people. We'll talk here a little bit about economic nexus rules. This is tied to the next slide on apportionment, but ultimately a lot of states have put in place now revenue thresholds, and they vary by state. Most of them are at 500 grand and up. But some of those will drop down. There's states out there now that are using 100,000 for income tax. That all states or most states are using $100,000 for sales tax. And so those are economic nexus rules are starting to come into play in a lot of places. And it's important to move and analyze those things. Apportionment. Historical sourcing was based on cost of performance, and what that looked at was rules. Where was I providing the service from? So if you're thinking about a law firm and the attorneys are all sitting in an office in one state, that's where your cost of performance is, and that's where you would source the revenue. This rule is still being used in about 10 states. It's being phased out slowly. It was quick there for a while in the early 2000s, but it's slowly starting to phase out in the remaining 10 states. The new sourcing rules that we need to look at are based on where our customers are and where they are receiving the benefit. That may not be their billing address and could be a customer's customer location that we need to look at and see where is our customer really receiving the benefit. And this is used in about 30 states. And what you really get into and question is, how do you determine where the benefit is being received? And the regulations in like California and New York are very good at guiding us down that, but the rules are different, again, state by state. And I think that's full employment for Dustin. I love differing rules by the states because that gets me a lot of questions and opportunities to consult with clients. It also creates some opportunity for us to kind of look at sourcing and are there ways that we can get to a lower effective tax rate for people. Indirect tax, I'll touch on this just because we do see this pop up in M&A deals and sales tax, use tax, they're complementary. On services, it's a constant area of discussion in the fact that states are looking to expand their base and push things, get tax dollars from people who are outside their state, but might have nexus with their state, so they're trying to basically transport the tax off of their constituents into people outside of their voting block. But expanding sales tax to services is something that's talked about in every state every year, and we're seeing more and more states that are taxing more and more services. There's 4 states that tax services in general. Other states, they have to be explicitly listed in the statute to tax the services. But you do see that states like Texas, states like Washington, they tax a fair amount of services. And so it's important that we take a look at those things. And with that, I will turn it over to Cole for polling question number 2.
Great, thanks, Dustin. Second polling question we have, when was the last time your company went through a nexus study or considered where employees are currently working/traveling? A, 6 months, B, 1 year, C, 3 years, or D, prefer not to say. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Please make sure that you're selecting your answer choice within the slide window and not adding to the Q&A window. And then for those of you who would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. We will also be sending the slides via email tomorrow, along with the recording of the webcast. And with that, the polling question is now closed, and we'll be going to Jarrid. Jarrid, the floor is yours.
Yeah, thank you, Cole. So we'll be jumping into some tax strategies and credits that you may be able to apply to your business investments and operations here. The first one being cost segregation. Ultimately, it's an income tax deferral strategy that could be applied to the cost to acquire or construct real estate assets, including leasehold improvements. The exercise identifies assets and components that could be depreciated more quickly over 5, 7, or 15 years, as opposed to real property that gets recovered much longer. So it's really a play on the timing of depreciation losses, accelerating those up into the early years of ownership and creating a tax deferral benefit. It provides the most value for those companies that own significant real estate assets, buildings that are $2 million or more, or leasehold improvements, or renovations that are $500,000 or more, especially for those companies that are adding to or growing the last couple of years, opening new locations and have the taxable income to where they could use those accelerated depreciation benefits. Keep in mind, too, a number of states don't conform to federal accelerated depreciation provisions, including bonus, so it can provide pretty meaningful state benefits as well. Put up a couple examples on the right-hand side of items that we're identifying through the exercise of a study. So in addition to the easily identifiable machinery, equipment, furniture that are easy to identify, we're really digging into building structures and systems, identifying things that are directly related to end-use business equipment, things that are decorative, easily removable in nature, that don't directly relate to the general operation and maintenance needs of the building. This is based off about 30 years of case law and regulatory guidance, speaking to the character of property. It's a brief example of a $8.5 million leasehold improvement. This was done to a high-rise office building in New York to build finished office space. And as you can see, the exercise provided about $4.5 million of additional depreciation by safely documenting what qualified as the 15-year qualified improvement property, as well as about $2 million of 5- and 7-year property there. Laura touched on the phase out of federal bonus depreciation. I would say the key takeaway here is that it really provides more value to reconsidering cost segregation. Aside from just cherry picking, easily identifiable items, we are really digging into those building structure and system components to get an extra bump in depreciation. So in years past, when we had 100% or 80%, it may have made sense to kind of look topside and see out of a $8 million improvement, $2 million of its furniture, fixtures, audio, visual that we all know is 5-year property, but maybe doubling down on that, right? Digging into those systems to maximize losses there. The next strategy is the 179D energy efficient commercial building deduction. This is a deduction and not a credit. It commonly gets confused with credits, but ultimately what it is, it's a program to incentivize the installation of energy efficient building property as a part of a new construction or renovation to an existing building. It's been around since 2006, but underwent pretty significant changes about 2 years ago as part of the Inflation Reduction Act, really changed the value and the utility of the deduction. And it's available for commercial building owners who are constructing or renovating their own properties. It's now opened up to real estate investment trusts, as well as designers, those parties that are deemed designers of buildings owned by exempt organizations. It's really to incentivize people like architects, engineers, design build contractors to engage in contract with these type of entities who otherwise can't use the federal deduction, so it can be allocated to those designers of mechanical, lighting, and envelope systems. The deduction ranges from 50 cents to $1 per square foot based off the annual energy performance. And then there's also a bonus deduction that could get you $2.50 to $5 per square foot. So increases by a factor of 5 there. Because of the square foot model of the deduction, we definitely recommend it for larger buildings, starting at 50,000 square feet or up, just based off the cost to model the annual energy power consumption, energy performance, and so forth there, and to certify the buildings. Elaborating on the bonus deduction a little bit more, that's available for projects that begin before January 30th, 2023. For projects that started after said date, you have to comply with local prevailing wage and apprenticeship requirements to be able to get that larger bonus deduction. So here's an example of the maximum potential deduction based off a couple of different types of buildings and the square footages there. You'll notice we have schools listed twice. That's definitely something that we see quite a bit among our client base for the design build contractors, mechanical engineers, architects who are deemed the designers of those for school districts, assisting them and helping them plan for that pass-through deduction that they could get for designing those energy efficient systems within the buildings. Note that these deductions too assume the maximum deduction amount. To be deemed a designer, the IRS has set forth some specific criteria. You have to be the person actually creating the technical specifications for lighting, mechanical, or building envelope systems. Merely installing the property doesn't quite get you there. However, for general contractors, specialty contractors, based on the language of their contract and what they're actually doing, can get them there. Ultimately, though, it's more of a clear-cut case for those engineers and architects, especially if they're the stamped designer on drawings there. The process at a glance for designers, the first step is doing some due diligence up front, making sure that they are considered as a designer, and getting a signed allocation letter from the exempt organization to receive that deduction on their behalf. Engaging with a third-party professional to model the energy performance using licensed software and who's licensed as a professional engineer in the state where the building's located. They're going to end up doing an on-site building tour and inspection, as well as providing a certification that substantiates the deduction. And with that, Cole, I'll turn it over to you for the last polling question.
Thanks, Jarrid. For our third polling question, we have, has your company taken advantage of cost segregation or 179D strategies in the past? A, no, but is something we'd like to learn more about. B, no, this is not something we have considered in the past. C, yes, we are currently taking advantage of one or both planning opportunities. Or D, not relevant to my company's operations. Give about 10 more seconds for you all to get your answers in. And just as another reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of 4 polling questions. Once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. Also, at the end of the webcast, a survey link will appear. We'd appreciate any feedback you're willing to share, and we'll use the information to develop future webcasts for you. And the polling question is now closed. Back to you.
All righty. Save the R&D portion of the presentation for last today. I know we have about 10 minutes left, so I'll try and move through this quickly. But as you heard at the beginning of the presentation, starting in tax year 2022, the tax law has changed, and now companies that have research and development expenses, or sometimes referred to as research and experimental expenses, have to capitalize and amortize those costs over a 5-year period for domestic expenses and over a 15-year period for foreign expenses. Now, with the change in the the administration coming up here, hopefully the government makes some adjustments to the tax code that allows companies to continually expense in the future 100% of their R&D domestic, but we'll just have to wait to see what happens on that front. But for now, we have to think about if your company has research and development expenses. And really this, I guess, something to note is this does include software development costs. So even if you're not in the business of software development, maybe you are hiring third parties to perform software development on your behalf, then, something to think about, because the requirement to capitalize and amortize your research and development expenses, that is a requirement of the tax law, as where pairing that with also going and claiming the R&D tax credit to help reduce your tax burden is an option that you can decide to elect into as part of the tax law as well. So what does research and experimental expenses or research and development expenses mean? These are expenses in connection with the taxpayer's trade or business, which represents research and development costs in the experimental or laboratory sense. And it also includes incidental costs in relationship to the development of a product, a process, a technique, a design, a formula. There isn't a great definition that the IRS has put out about what is or isn't research and development. But, if you're doing engineering, software development, design work, this is definitely an area of the tax law that you should consider. Like I said, incidental costs. So what does that mean? That could mean additional overhead expenses, not just the time spent by employees performing any design work or research and development or engineering or computer software programming. It can bring in all the costs associated with that particular employee. Maybe it's a portion of the rent, the utilities, other overhead expenses, medical healthcare costs, things of that nature. But the IRS right now doesn't have a great definition on what's incidental. So I put up a couple different definitions from a couple different sources just for your benefit. I think the thing to keep in mind is that over the past couple of years, the IRS has provided taxpayers with interim guidance around what is or maybe isn't considered research and development, but it hasn't provided a concrete framework to help taxpayers understand how to calculate these numbers. And so, interestingly enough, in the last month or so, the IRS has come out and said, hey, we're working on more concrete regulations that hopefully will come out in the winter to explain what is or isn't research and development expenses for tax purposes. So I think stay tuned, I guess. If you have questions about this area of tax law, please feel free to reach out. But stay tuned, because the environment around this is shifting and could continue to shift kind of as the new administration comes into play, and as Congress starts evaluating tax changes for the future. I mentioned this quickly. We have 5 minutes left, but there's other types of costs to consider for research and experimental purposes. The one thing that I want to just comment on is that if you're having to amortize research and experimental expenses, you might as well look at seeing if you can take advantage of the R&D tax credit, because ultimately the R&D tax credit is a permanent tax savings. There's like 38 states or 36 states that offer a tax credit along with the federal tax credit. The federal R&D tax credit is a 5 to 10% savings for every dollar found, and that can kind of help offset some of the challenges around having to capitalize and expense slowly your R&D costs. There's a 4-part test here. I'll just mention it quickly. This is how the IRS, you have to meet all 4 parts for something to be considered research and development for the R&D tax credit. But number 2, technical uncertainty is the only piece that needs to be considered for whether it needs to be capitalized on the tax return. So I'll move to the last polling question, Cole.
Great, thanks, Josh. For our final polling question we have, has your company considered identifying both research and experimental expenditures and research and development tax credits? A, yes, currently taking the R&D tax credit and identifying R&D expenses. B, no, but it is something we would like to learn more about. C, no, this is not something we have considered in the past. Or D, I don't think my company has any research and development related activities in 2024. And while you're answering the last CPE question, looks like we probably won't have enough time to go through Q&A during today's session. However, we will reach out to anyone who has submitted a question via email within the next 72 hours. With that being said, I'm going to close up the last question, and back to you, Josh.
Thank you. It looks like about 50%, hey, maybe R&D activities and expenses don't apply to you, but it looks like we have quite a few that are already taking it into consideration. And if you want to learn more about R&D or any of the topics that we've discussed today, then please feel free to reach out. I guess we have a couple more minutes, but we will I'll quickly, this is a chart that explains both the R&D expenses that can be captured for the credit. That's the smaller circle under Section 41. And then the larger circle, Section 174, is the expenses that would be capitalized and amortized for tax purposes. You can see here that there's a small portion of the expenses relate to the R&D credit, but then a larger bucket of costs have to be considered for capitalizing and amortizing. And just, I guess, really quickly, one last comment here. There's things that you should consider before you move forward with an R&D tax credit. Is your company in a taxable position in which they can utilize the credit, or can utilize the credit in the future? And then also keeping in mind that the credit can carry back 1 year, the credit can carry forward for 20 years. And then the last piece is for the R&D tax credit. There also is a contract research analysis. If you're being hired by third-party customers to perform research and development, then there's some additional requirements to think about, and reading through the contract language between your customer and yourself to make sure that you can qualify for the credit. But ultimately, like I've said earlier, the credit is a permanent tax savings. And with that, I think we're at time. So thank you.
Great. Thank you, Josh. To wrap us out, thank you to Laura, Dustin, Jarrid, and Josh for a great discussion today. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. Unfortunately, we did not have time to go through Q&A on today's webcast. However, we will follow up with you after the webcast. Also, feel free to reach out to our presenters if you have any additional questions. Their contact information is in your console. There are a number of additional resources in the upper right corner of your user console that may be of interest to you, so definitely check that out. If you've met all CPE requirements for today's webcast, your certificate is now available to download in the CPE progress window. A copy will be emailed to you in 2 weeks should you have any difficulty downloading it now. As a reminder, if you attended today's presentation in the group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And finally, here is a link to an online survey for today's presentation. Thank you for joining our webcast, and we hope you will see us again next time. Thank you. Take care.